Okay, hey guys, welcome to module number 7 of 8 in this financial mastery or this financial masterclass series. And today we're going to talk about raising money. We're going to talk about the ins and outs and how it works. And we're going to use the recent COVID-19 bounce back C-bills as examples of that, because in the big scheme of things, in the life of an entrepreneur, especially if you're going to scale, you need to understand how money works and the borrowing and lending of money and all the ins and outs. And as a reminder, module number 8 is about mergers and acquisitions. So on Friday, John, we're going to be talking about buying other businesses and growth through acquisition, Simon, which is a very hot topic and I know a favorite one of yours. So with that said, let me go on over to the slide deck. Okay. As per usual, just give me a thumbs up. Let me know that you can see the slide deck. All right, good. Okay, I'll move your videos to the top so I'm not talking to the side of my screen. And here we go. So, recap on the previous module. We're talking about success planning, right? Budgets. We're talking about if your business doesn't work on paper, it's not going to work in practice, Sonia. Right? You've got to make it work on paper. Think it through on paper in numeric format. And if you remember, there was the 4 key drivers. There was the income, the revenue. Then there was the cost of acquiring the customer, Nick. There was the cost of servicing the revenue, John. And then there was the cost of being in business. And they're all interwoven. And you've got to think it through on paper, because if it doesn't, it's not going to just magically fall together. Always takes twice as long, Simon, and costs twice as much as you think. But that said, today we're going to talk about finance, raising finance. Let's start for 10. Why the hell would you want to raise money for your business? Sounds like an obvious question, Haiji, because normally the cursory response I get, Neelam, is, well, because we need it. But really, what is it? Borrowing that money is leverage. Finance is like petrol for your business. Okay, it can be the fuel. Cash is the fuel that makes it go, but borrowing it can be like a catalyst. It can be an accelerant, Alison. Okay, if you've got a business that isn't working, it needs cash to stay alive, typically, but you've still got to fix the underlying issues, Graham. But if you've got a business that works well, you can supercharge it by putting petrol on the flames. It turbocharges it. It can accelerate it. So said differently, cash equals leverage. Okay, so you're trying to grow, but it feels painful and hard work. You're trying to push it up yourself. Cash just tips it, can accelerate your growth upwards. If, Barry, and it's a big if you know what you're doing. Word of warning, Neelam, my man crush is on the screen, Warren Buffett. When you combine ignorance and leverage, you get some pretty interesting results. So in the first modules, we spoke about the foundation. We spoke, Alison, about the importance of good management accounts. We spoke, Aaron, about the key people on your team and what you need them and how you read this language of business. We're now getting into stuff that can have tremendous upside, but has more risk attached. Raising money, and in the next module, really potent, raising money in the context of buying other companies, Rachel. Okay, so let's talk about it at a base level. Fundamentally, Graham, there's 2 types, or 2 sources, if you will, Neelam, of cash. 2 places that it comes from. Okay. You can either borrow it in the form of a loan, which means you have to pay it back, or you can raise money through the form of equity, the sale of equity. So you can take on a business partner, right? Famous for IPOs. When companies, it's out of arm's reach, but just in my library here, I've got Shoe Dog, one of my favorite books of the last few years by Phil Knight. If you haven't read it, it's well worth a read. Shoe Dog by Phil Knight tells the story of the first 20 or so years of Nike. And the bulk of those 20 years, he was cash strapped. And he was borrowing money, and the thing that really kicked him over the line, Simon, what really made him make money and made him a billionaire, one of the richest men in America, was he had an IPO. An IPO stands for initial public offering. In other words, Simon, he sold off equity in the business, okay, in order to raise money. Okay, Richard Branson's famous for this as well, building the Virgin Empire. He was borderline broke and going to go under, and he sold off Virgin Music for £650 million in cash to raise the money to be able to support the growth of Virgin Atlantic. And time will tell whether or not he was wise making that decision, Jim. Okay, so let's talk a little bit about the pros and cons of these, and really just think of this, Nick, as education in your understanding about how this works. Okay, there's variations on this, but I'm keeping it very simplistic. So where do you get loans from? Where does the money exist? In fact, before I say that, Neelan, a more perhaps pertinent point. Going back 10 or 15 years when I was maybe a bit longer now. Christ, I'm getting old. Going back some time, I used to feel like there was never any money. Like it was hard to get money in the world of business. Now that I've come a long way on my journey and I've had some big highs and big lows along the way, I now understand what a mentor of mine meant 20 years ago when he said, Dan, there is more money in the world sat on the sidelines than you can possibly imagine. Desperate. There's more money than there are good business deals to do. And I think that's absolutely spot on, hygiene. If people won't lend you money, it's because either your business deal isn't that good, or possibly, Alison, it's that good, but you've not articulated it well. But the reasons for them saying no is going to be different if it's a lending institution. Excuse me. Tickly cough. If it's a lending institution versus if it's an angel investor. So where do you get loans from? Bank. Let's just talk mainstream. You get them from a bank, a mainstream lending institution. Where do you get equity finance from? Okay, you often raise it through angel investors. An angel investor invests it in your company. Could be angel investors, could be private equity, could be venture capitalists, but we're just going to label them as investors. Okay, but what are these people that have the money, Graham, Simon? What are they looking for? Well, the lenders, what they're looking for is a fixed ROI. They're trying to get a return on their capital, right? And what they're really after is they'll take a lower return, but they want more security. What an equity investor wants, however, is they want the home run. So they're looking for, Simon, they're much more likely to be enticed, John, by a much more attractive upside. But in exchange for that, Sonia, Jim, they'll tolerate a much higher risk. So how do they assess risk? Well, the bank's mantra is this. And going back, it's probably 4 or 5 years ago now, I had 5 companies, okay? And they varied in size from a couple of $100,000 to kind of 5 million in annual revenues. However, I will tell you that the one that made the most money was the one that I never spoke about. And that was it was a lending business. What I used to do, John, was with another investor, we used to lend money to other businesses. And we would lend money to businesses that struggled to get it via a high street bank. Okay. So we were kind of a hybrid somewhere between the two of these. But in that time I learned the mantra was the return of your capital, John, is more important than the return on your capital. Right. So banks that they're saying, okay, I want to understand and have security that I'm going to make my money back. The reason why the recent C-bills and bounce back loans, there was so much resistance from the bank is because it's so cheap, which is good for us as business owners if you wanted to and took advantage of some of those schemes that were offered. But it's bad for the lender. Why? Because the rates are so low. And if you're only making 3.5% on your money that you've lent out, how many people have to go broke, John? right? For you to be in deep, deep water. So it's entirely plausible, right? That with these bounce back loans, the vast majority of those aren't going to get paid back, and that there will be a significant net loss on that money that was lent out. That's why the banking industry was slow, right? And the same with the CBILS loan scheme. So the bank want to know, are they going to get their money back, right? They want security. I put your house down here because they often want a personal guarantee as well. That's typically in the way that the world works. The COVID-19 situation was a very rare, well, the only exception, probably the exception that proves the rule. And anticipation is, I went for a socially distanced walk this weekend with somebody from the city that managed $750 million worth of pension fund money. And his perspective, Simon, was that the lending markets are going to be ridiculously hard to borrow from in the not too distant future because they've lent out so much money so cheaply. And that kind of makes sense. But they want to know the strength of your balance sheet, John. They want to know, as security, are they going to get their money back? That's almost the be all and end all. Whereas the investor, the equity investor, is much more tolerant to a riskier situation because they've got the advantage of a much bigger upside, but they are going to do due diligence. They're more likely to be investing in you, the entrepreneur, even though, Nick, it takes the form of your company. Okay, Neelam, so they want to know, are you trustworthy? Are you integrous? Are you the kind of person that you can count on when things go wrong? It's not if, Barry, it's when, right? So, pros to borrowing money in a mainstream lending situation, like taking a loan. Okay? The pros of a loan is typically it's much cheaper. It's a lower cost. But the cons is it's much more rigid. If you default on these loans, rest assured you are going to be paying it back. And there are consequences. Even with the recent bounce backs and CBILS, and loads of people are going to default, that will happen. There will be consequences. People are going to get pursued. People are going to get made personally bankrupt, even though they thought there was no personal guarantee on it because they misused the funds, Simon. And some people are going to go to prison. Hands down. Because the banking system will have belts and braces on these things. I just read a CBILS loan documentation for a private client this morning, and there are very strict rules. Things like, if you're more than 7 days late, they're going to charge you 15% of the overdue amount as a admin fee. All right. So in this particular example, it was a £250,000 loan, which had monthly repayments of about £6,000, Graham. But what that means is if they were 7 days late with a payment, that means they're going to get fined £900 as an admin fee, right? And there's lots of other consequences as well. They can effectively recall the loan at any time. That's not uncommon. But you've got a lot of capital for a low return. In this example, it was about 8%, I think, in this example, which some people might go, oh, that's really high. No, historically that's really low. Okay, it's just that the bounce back 3.5% has got people has given a different frame of reference. When it comes to taking an equity partner, Rachel, the huge pro is it's much more flexible. Ask any angel investor, and they'll tell you that, it took longer than they thought, or they needed more money, or there needed to be more flexibility. And they're generally much more willing to be flexible. Okay. So it can create much less pressure on you than if you owe that, you took that money from a bank. Okay. It's much more flexible, but the downside is it's going to cost you a lot more. If you've sold off a stake in your company and you do succeed, Simon, you're going to end up paying a lot more money and you're going to wish you could have borrowed it from a bank. Okay. So these are the two primary categories, Haiji, of raising money. If you're trying to raise money to ignite your business, to kind of accelerate it, Allison, because you feel like you're doing everything right. Okay. So how do you get it? In fact, actually, no. Let me pause. Jump out the slide deck for a second. Okay, jump over here. So let me take questions from that. I can see quite a few things bobbing up in the chat, so I have a quick look at this. Nick says, Carl Icon, Michael Dell swung from PLC to private again. What's the advantage of being public, being your business partner when selling shares? Fascinating. So you were the precursor to Funding Circle. I'm not going to claim to be the precursor to Funding Circle, Nick, but yeah, money lending's the second oldest profession, I think they say. Okay. So let me open to you. That was probably perhaps more commentary was in the chat than questions, but questions about types of lending, and then we'll talk more specifically about how you get it. Anything spring up? Or Nick, did you want to add to your comments that you put in the chat? Right.
No, it's just the rationale of the benefit of the public being your business partner when selling equity in an IPO. I mean, one of the reasons Dell went back to private is for the freedom and the autonomous decision making he could have.
Yes.
So there are downsides, aren't there?
So something like this, I was reading a book at the weekend, and there's a great quote in this book by Charlie Munger, Warren Buffett's business partner. It's not supposed to be easy. Anybody who finds it easy is stupid. I love that quote. And that's definitely true on, do you borrow money from the banks, or do you borrow money from the sale of shares? So we're going to talk about it more on Friday. But Jim Radcliffe, who in 2018 was declared the UK's richest man, he's got a net worth, Sonia, of about £20 billion, I believe, currently. And he's got the largest privately held company, I think in the world, but certainly in the UK. It's privately held. It's not public. It's got over 60 billion in annual revenues. It's in chemicals, and so it's a massive company. But basically, and we'll talk about it in the context of M&A, he just borrowed money. His whole career, he just borrowed money from banks. So it was always in the form of loan. So this company was 60 billion in revenues. Do you know how many shareholders it's got?
One, presumably.
Three. And two of them were there from the start, and one of them joined very shortly thereafter, right? So all the money was borrowed by banks. And if you read his book, which is called The Alchemists, the Ineos story, it'll talk about that, because there's not a right and wrong, John. That's the point I'm trying to make. It always depends on context. So on the one hand, it's made him the richest man in the UK, just borrowing the money and never ever selling off shares. But equally, it nearly took him down. In the last financial crash, 2008, it nearly took him down. The banks nearly took him down because they were that rigid.
But why would it have been easier to stay afloat if he was public?
Well, so let's talk about selling shares, and I'll talk about public specifically, okay? Because I sold one of my companies to a publicly listed company, so I did a lot of ins and outs of that. The reason why, in fact, I'm going to put it out to the group. How does it affect your balance sheet, Simon, Jim, Sonia? How does it affect your balance sheet if you get a loan? And then I'm going to, as a follow-up, ask you, how does it affect your balance sheet if you raise money by selling off shares? So, in fact, I'll answer it for the loan, and then you guys can think of the share equivalent. So, if I raise £100,000 from a bank, okay, I get £100,000 in cash deposited in my bank. That's the asset side of the balance sheet, okay? But on the other side, I've got £100,000 liability to the bank. That's the repayment of the principal, that £100,000 loan, right? So there is zero change in equity. So while it makes the balance sheet more liquid, there's no change in equity. The balance sheet doesn't get stronger in the traditional sense. How is it different? Rachel, you'll know the answer to this question. How does it get different with if you raise money by selling shares, equity, whether it be privately, Nick, or whether it be on an IPO? How does it change the balance sheet? Who wants to take a stab at this one?
Cash up, equity down.
No.
Equity is the same. Cash up.
Well, cash is up. So think of a balance sheet. A balance sheet's got a balance. So the cash has gone up by 100,000.
Cash is up.
Yes, the cash is up by 100,000. That's the asset. So the balance sheet has to balance. So either liabilities has to go up by 100,000 or equity has to go up by 100,000. So it's not liabilities because you don't owe anybody anything. You've sold off the shares. So actually, effectively, you've you've issued them £100,000 of shares in your company. Right? So companies, when they have an IPO, but the same's typically true with a private investor, they create more shares in this company. So they've printed more shares of this company, which means that the equity's got £100,000. So the cash has gone up by £100,000, but the equity's gone up by £100,000. So the balance sheet still balances, but if you raise money by equity, the irony is your company's much more creditworthy because the company owns its cash. Now you've taken on another shareholder, but that same pot called the company is just divided up amongst more shareholders in however the ratios work. So raising money via equity creates a stronger company. But the downside is you as an individual have less of a stake. You have less of the ongoing returns of that company. So the reason, and now let's take it another level, Nick. Actually, first of all, before I talk about publicly listed, let's be really precise. Did that make sense? Okay. So now let's talk about publicly listed. The reason why most entrepreneurs, big exit is either selling their company or having an IPO. The reason why a lot of them will choose to have an IPO if they can, if their business is big enough, is because the public is far less discerning than an angel investor. So let's pretend, Nick, your company's worth £1 million. Okay. If you try and sell the same company to one angel investor, he's going to drive a much harder bargain than if you sell 1,000 shares in that company on the stock market at £1,000 a share. Okay. And the reason why is, experienced investors are normally more sophisticated, so they'll drive a higher bargain anyway. But secondly, it's also higher risk for them because he or she is putting up the whole £1 million on you. Right? But if you're selling to the general public, mass market, people more like to go, oh yeah, I'll take a punt. Right? So therefore, the valuations of companies that are publicly held are much more generous than if they're privately held.
And it's easier to liquidate though if it's public.
Correct. Because that's one of the reasons. If you're on a public exchange, it's easier to get in and out of the company. If you're buying and selling shares privately, that's much more cumbersome than if you're just on a share exchange.
Although I meant from the owner's perspective, they could liquidate if they want to buy an island or something.
Sure, but that's why one of the reasons why the multiple is higher, the valuation of the company is higher if it's on the public market, because anybody can get in and out. I can buy it today. If I change my mind tomorrow, I can just sell it. Okay, it's easier to get in and out and be liquid, right? And therefore, in theory, it's de-risked than if it's privately held. Okay, so that's why people will vote on the stock market, because effectively it increases the company valuation. So oftentimes, by listing it on the stock market, your company's valuation has more than doubled just by the fact it's liquid. So even if you sell half your shares to the open market, actually your half that you've still got is probably worth more, right? And if you still continue to drive the share price up, it'll be worth more still.
So if what's his name went public, he might be worth 40 billion.
If Jim Radcliffe went public, I strongly suspect he would be worth more. But then smart people listening to this will go, well, why has he not done that then? And I'll speed this up and go, I'm sure he's given it some consideration, but it's because you're going to have a loss of control. Right? So Michael Dell went back privately again. Virgin was listed and then privatized again. It's gone through in and outs in different stages. So the point, Neelam, is the right tool for the right situation. Right tool, right situation. And it's not just equity or loan. It's actually, well, what's the terms of the loan? What's the terms of the shareholder? Right? So let me meet you again and go back into the slide presentation, share screen. But there's something that's in common. Okay. How do you get it? So if you're trying to raise money, okay, whether it be from an investor or from a bank, you're going to need three things or categories of things. Number one, you're going to need your management accounts. Alison, you're going to need your management accounts because the investor or the lending institution wants to see the financial health of your company. And that's going to be at least balance sheets and P&Ls. Okay. Previous couple of years, 2 or 3 years, and the current financial year in all probability. They're going to want to see projections. Now, the banks are slightly less bothered about this than the investors. Why is that? Because remember, if your balance sheet's strong enough, because in a nutshell, with the recent rare exception, a lending institution isn't going to lend you the money unless your asset section, your equity, Neelam, on your balance sheet is much higher than the loan amount, right? Because then they know if it all goes wrong, they're still going to be able to seize assets and get their capital back, okay? But an investor might not have that security, so they're going to be much more stringent on diving into the budget and the forecast of what you think is going to be happening. But giving them numbers that have been made up on a spreadsheet isn't going to serve you. They're actually looking, Simon, to see your level of financial literacy, okay? And then finally, Graham, they're probably going to want to see a business plan. They want to understand. So yes, I can see a cash flow forecast. I can see a budget, but I need to see written down. I need you to explain to me the key points. 1, 2, 3, 4 page document, depends on the amount of money that you're looking for. But there's probably going to be a summary sheet and then a couple of pages of supporting evidence. Now, if you think about it, you should have that anyway, right? Barry, this is how you should run your business. You should have management accounts, you should have the projections, and you should have the business plan. But most people don't. I in the past have been to lending institutions to borrow money, Rachel, even when I had no intent of borrowing it. Why? Why might that be? It's because I was litmus testing my business plan. Think about this, Barry. If they won't lend me the money, it's a sign that they don't believe that they're going to get it back, or they're not convinced that the return on investment is worth the risk. I want to see, I want people to want to lend me money, even if I choose not to take it. Right? You only have to be grilled by so many investors before you realize they're looking for similar things. And I used to get pissed off. Oh, they won't lend me the money. This is ridiculous, blah, blah, blah. I didn't understand how the game works. I didn't understand that they need this information. They're assessing me. Now, even if they still don't lend me the money, it doesn't mean that they're right and I'm wrong. But just get your ego out of the way. If they won't lend you the money, it's perhaps a sign that there's something in your plan that's not strong enough, right? And it shows up either in your management accounts, in your projections, or your business plan, or all three. So whether you're looking to raise money from a bank or whether you're raising money from an angel investor selling off the equity, you're going to need these three pieces. There's just going to be more emphasis on certain parts than another. And all this will be magnified when we talk about it in depth on Friday, when we talk about mergers and acquisitions, and we talk about buying up your competitors. And we're going to talk about how 1 + 1 = 3. We're going to talk about some of the ways of doing that. But whether you're buying up competitors or whether or not you are just trying to fuel your growth, raising finance is a key part of it, because sometimes just growing slow and organically it is the wrong move if you know what you're doing and you've got your business aligned, right? You need to get market share, and you could make this the argument for right now, when we're in a recession, is a time to magnify your growth. That's normally when market share, you can increase your market share for pennies in the pound. Some of the biggest company in the world, you know, the Ubers, the Airbnbs, were founded in the last recession. Okay. And for me, I trebled in size in the last recession. Okay. Because I bought a few companies because I knew where to raise the money from. And I'm going to do some of the tactics which we're going to talk about on Friday. So with all that said, we've spoken a little bit about raising money, whether it be this module or one of the previous modules, whether it be relating to your team, whether it be relating to your budgets, Simon, cash flow forecasts, Jim, balance sheets, Graham. What questions do you have? I'm just going to look in the chat first, and then you can unmute yourselves. Oh, great question. So Neelam asks, how do, I thought I was going to say assets. How do you assess the best fit for your business when looking for investors? So I'm going to come to you, Neelam. Let me unmute you. I think, yeah, there you go. I think you need to do it yourself. It doesn't seem to let me want to unmute you. So Neelam, elaborate on that question. Tell me a little bit more about what you mean.
What I was so at the moment, basically, I'm back in startup stage again because I've been out of business for a while. I was just thinking in the abstract, so I don't have a practical example. So that's the first thing. What I was thinking is that depending on the nature of your business, I mean, there's going to be lots of places where you would look to find investors. There's going to be people who will connect you. They're not necessarily people that you know, trust, and are starting off with. So in terms of working out, if I want someone to invest in my business, they're potentially going to be a business partner for me in the future as I run a business. So what are the things that I kind of understand what you've said about the sorts of things that an investor is going to look at, but what am I going to have to think about if I'm looking for someone to invest?
Great question. All right, so let me answer that. So firstly, you've got to be clear about what you want for, right? So really on this session, all we've spoken about is capital. Because if you're after capital with that kind of summary page that I shared, effectively, if you can borrow it from a lending institution, or you could borrow it from an individual, but in the form of a loan, i.e. not selling off equity, it's probably going to be cheaper, right? But often, but not always, it's more consequence to you if it goes wrong, okay? If, however, you choose to raise it in the form of equity, so you're sharing some of the upside and you're selling off some of the shares, but again, this is if you're just after capital. To be overly simplistic, just be very clear that you've got very precise documentation, i.e. they're a passive investor. If they're just putting it in the cash, you know, it's going to come from one of the 3 F's is going to be the most likely source: friends, family, and fools, right? They're the 3 categories of people that are most likely to lend to a startup business. And for a startup business owner, unless you are looking for something more than that, which I'm going to come to in a second, that's the right thing to do, right? Because as in it'll be cheaper. Now, I don't like, I did do it a long time ago, but I wouldn't do it now. And I tend not to lend money out to friends and family because it's going to end in tears. I'd rather, I've lost good friends for loans. And when I do it, I'm very rigid, and it's a very clear loan agreement because it needs to be non-emotional. Okay. So now let's talk about the other element. If, Neelam, you're after somebody that's going to bring more to the table, I just think it's the same premise. I want to be very, very clear and precise. What is the outcomes that we, the company, are after? And what are their deliverables if I'm expecting their expertise, if I'm expecting introductions, if I'm expecting, I don't know, referrals, if I'm expecting a certain amount of time commitments. the way I heard it described recently is an agreement. I want to have a written agreement, but it's not actually an agreement. It's a disagreement. I want to be really detailed about what happens if it doesn't work, right? Or if we fall out over something, right? This is what gets people burned. So if I was trying to summarize it, it would just be to say, you cannot over clarify the terms of the transaction that you're looking to take place. So just be beyond crystal clear. And if it's just capital, it's a straight up loan. And even if it's from friends and family, I want a simplistic loan document that documents what happens, repayment schedule, etc. If I want more than that from an investor, great. I just need to be super clear about what I'm expecting of them or what they're going to get. So what they're going to get, what I'm going to get and what they're going to get. Okay? I really think it through if it went wrong.
Okay.
Did that help at all, Neil?
It helped, and I think I was also thinking about, I suppose, one of the ways that I might raise that question is, what's the kind of due diligence expectation on my side?
Good question. So I will shoot from the hip. So I want to know that they've got the money, right? As in, so I need to see that they're in funds. I want to understand the source of those funds. I'm also going to do my homework probably from a company's house point of view, see if they've got loads of dissolved arrangements, etc. Because I just want to understand it. You know, if they've got a history of loads of failed companies, all right, I want to understand what I'm going into. I am said succinctly, I just invested in a company with somebody that I know, like, and respect. And I've thought about doing business with this person for over 10 years, more than 10 years. I mean, I can remember our relationship back to 2008-ish times. So, and it's taken us this long. I mean, I probably could have done it 4 or 5 years ago, but it's very extensive, long-standing due diligence. And I haven't been researching for 10 years in order to make this one. It just so happened an opportunity was presented, but I felt comfortable. People are just way, way, way too quick to jump into bed, because you've got to just remember, you're getting married. You're getting business married. All right? If I'm going to get business married, I want to have gone on a few dates. Right? And the dates might take the form of a short-term arrangement or an interim loan or a consulting agreement. Okay? But I want to have gone on a few dates. And if I am getting married, I want a prenup. Right? So now that might take the form of just a really thorough shareholders agreement with push-pull clauses, i.e. what happens when one shareholder wants to leave, etc. But all that's going to take place. Again, it stems back up to, for most small businesses, if all you want is a chunk of money, it often is as simple as, well, I just need to understand the source of the funds and they've got it and they can afford to lose it. Right? If I think in the early days when I used to have to raise money rather than lend it out, I'd tell people whatever they wanted to hear in order to justify. I'm not proud of this. This was a younger, more naive version of myself, because I want to get the sale. But then when it blows up and then you found out that they borrowed the money from their credit cards or from their house or whatever, then that's what causes all the tension. If anything, I want to try and talk them out of it. I want to tell them how risky it is and how probable it is that they're going to lose their money. And if they still want to do it, great. We're all under no illusions about what we're doing here. So I'm going to jump on to the next question. That's okay, Neil? Yeah. All right. Okay, Nick. One was also good. What happens if either party passes away? Yeah, correct. Does the lender's estate receive it if they pass? Correct. Yeah. I mean, there's crazy in any family. I agree to work with you as your business, as my business partner, not your spouse, right? So yeah, fair points. And there's often a lot of, I forget the name of it, but the insurances whereby if one partner dies, the insurance pays out to the shares go to the other partner, and the insurance premium pays out, so that goes to the spouse in payment for the shares, right? Okay, let's go on the top. So questions from Simon, Nick, or John. You guys got any questions? Okay, Jim, Alison, or Graham? God, quiet bunch. Or I've not done a very good job today. Hi, Chi, Rachel. Who else have I got on here? I've got a bit mixed up with my order. Hi, Chi, Rachel, other Simon? Oh, thank you. Very kind. Someone said, too good a job. Okay, good. There's not that many of us on today's session. I suspect that because of the recent climate, a lot of people feel that they've got the raising money side of things handled. But actually, today's a tee up for Friday, which I did the preparation for this weekend just gone. And yeah, if you want to know what's made me more money than anything else combined, it's the mergers and acquisitions piece that we're going to be talking about this Friday. But I will also disclose in advance. It's also cost me and personally resulted in me being sued for millions of pounds as well. So we'll get to talk about the highlights of that on Friday. So any final questions from anybody before we go? Alison, Graham, Aichi, you're always quiet. I hope you're getting value. Oh yeah, I can see John. Yeah, go ahead, John.
Yeah, just on last week, you went through the cash flow forecast, the 13 weeks.
Yes.
I actually sat at the weekend and actually did mine for the first time ever. I've
Good.
never done it before. When you talk about 13 weeks, what happens when you get sort of 2 months in? Do you still need to be adding on to the end of that? Or do you start doing the next 13 weeks as a quarter?
Great question. So 13 weeks into the future, because that's a quarter.
Yeah.
Every week I'll touch in and I'll add a 13th week at the end. So it's rolling. So I'm always projecting 13 weeks out into the future. Does that make sense?
Yes.
So if you looked at one of my cash flow forecasts, like the spreadsheet can be as long as you like. I've got ones that go back to, because when I get to the next week, I update week 1 with what actually happened.
Okay.
And then I'll add week 13 to the end. So if you think about it, as it maps across, if you looked at one of mine, it might go 2 years into the past. And really, that's a statement of cash flow. What did happen to my cash over those 2 years? But in updating this week, oh, that didn't get paid. Okay, I'm moving that into next week's, etc. And then I'm always trying to stay 13 weeks out. So I've always got a line of sight, John, 3 months into the future.
Yeah, that makes perfect sense. Yeah. Okay, I understand that.
Was it illuminating? Did anything jump out of you when you had your first pass at it?
I just had to really go through the bank statements from the last 3 months to find out exactly what's going out, when it's going out, get the dates in there. From our point of view, the money in is very up and down.
Yes.
In the construction, some jobs could be 50,000, but only 20,000 could be materials.
Yes.
But on another job, you might have one that's only 20,000, but only 1,000 is materials.
Yes.
So you can't actually predict what money is going to come in that far in advance sometimes. But
sure.
You can have a best guess because you can obviously see what's happened in previous years. So you sort of average it out what you're going to roughly get and then take it from there. But the fixed money that's going out is very straightforward. All your insurances, we've got loans on vans and stuff like that. The only variable there will be obviously the materials. What materials? That's going to fluctuate quite a lot as well.
Yes. Oh, well, and by the way, that's the more erratic it is, the more you need to spend time thinking about it, right? And be conservative about what's going to come in, and overestimate, if anything, what's likely to go out. Okay. Comment from, thank you, Jim. It can be dangerous to sell shares. There was a health food shop who started up north. and the young girl got into a partnership with a local guru who ran it into the ground, and in the restructure turfed her out. Yep, definitely dangerous, high stakes. We're going to talk about it. A prelude for you for Friday. I've done 2 7-figure exits in my life. So I've done about 12, it's 14 now, I think, companies where I've bought, sold, merged. I've done 2 exits that were upwards of $1 million. And one of them was great and set me up financially for life. The other one, I'll just say it resulted in me being sued for more than I got. So, yeah. You need to know what you're doing. And I don't say that to scare anybody. I just think that there's a lot of gurus out there that are teaching about, oh yeah, you can buy companies with no money down, and you can, you actually can, but it's if you don't know what you're doing, you can get yourself in a world of trouble. Apparently, his party comment was, "Money is a game. Loving you have just lost." Shocking. Yeah. Yeah, another danger is the bandwidth. Yeah, the mental bandwidth, worrying about what a partner thinks it is. So there's a lots of ins and outs, but equally, business partnerships, when worked well, often my periods of fastest growth have nearly always involved a merger, or sometimes one where I went from mid 6 figures to mid 7 figures in a 2-year period, which was one of my periods of fastest growth in one particular entity, was fueled by the fact that I got a business partner who had a lot of money that they were willing to inject. Okay. They did more than just that, Neelam, but they put in a lot of capital, and that was the accelerant that funded it. Okay. But they got their upside. They got their upside. Oh, good question from Rachel. What are the secrets of great business partnerships? Yeah, I was going to say, don't do it. I think I probably said it in respect to the answer to Neelam's question. I think that I'm paraphrasing somebody else here, but it sits well with me. When I look back and look at all my failed business partnerships, I realized there was one common denominator, and that was me. So I don't do it that often, but when I do it and I've got business partners, it's just not equal in most cases. I'm very clear about who's responsible for what, who's the majority owner, who has control, etc. And you've got to be very, very, very clear, transparent, upfront, and talk communication constantly. Very good. Any final questions before we call it a day? All right. Well, you've been great. And get ready for Friday, because Friday, if you want to know how I ended up getting sued for millions of pounds, the worst and the worst weekend of my life, holed up in a hotel with a lawyer who I was paying 500 quid an hour to sit there and defend me, then it's like out of a good Hollywood film. This one that's coming this Friday, but also the upside as well. So I hope you're enjoying this. See you next time.